This shocking news will go global and could send markets crashing. It's easily going to be the biggest story of the year. I'm going to show you why it means we're screwed. Let's turn to Bloomberg, where we picked today's story by the headline, as another U.S. jobs markdown sets the stage for Fed cut and BLS criticism. And I want to understand what's coming tomorrow and why it's so important, because we're getting the QCW revisions to the non-farm payroll report, and what it's likely to show is the U.S. economy is far weaker than anyone thought, because the expectation is it's going to have a massive downward revision to the previous number of jobs created. Now, on top of this, it's likely going to infuriate President Trump, because it's going to indicate that his policies aren't working. And as far as the Fed's concerned, it's going to show that they're way behind the curve. But there's a problem here, because when you have bad data, well, you get bad policy. Now, there's a big question I'm going to leave you with at the end of this segment, but hang tight. Let's dig deep here, because this is going to go global. It's easily going to be the biggest story of the year, and I'm going to make the case why it could send markets crashing. As economists at Wells Fargo, Comerica Bank, and Pantheon Macroeconomics now expect the Bureau of Labor Statistics preliminary benchmark revision on Tuesday to show that the March payrolls count was almost 800,000 less than currently estimated, or about 67,000 a month on average. Nomura, Bank of America, and Royal Bank of Canada said the downgrade could be even closer to 1 million. And that means this entire time, a lot of consumers, policymakers, everybody has believed that the U.S. labor market is far stronger than it actually is. And again, this is a big problem, because we talk about bad data, and that's exactly what we have from the BLS. And what does it lead to? Is bad policy. Now, I said this is going to infuriate President Trump, and for good reason, because a second year of sizable revisions to the employment count also risks drawing the ire of President Donald Trump, who has criticized the accuracy of the BLS data, because what he doesn't want to show is that his policy isn't working. Now, of course, we know the White House is going to spin this and say, look, the economy was already slowing down before President Trump took office. And of course, that is true. And that's the case we've been arguing for a while, that the trajectory of the economy can't be changed by one person. But both sides are going to feast on this in a big way, because the issue here with the BLS is the fact that they made major changes. Now, I believe this goes back to President Clinton's administration. I could be wrong on which president, but what happened is the data gathering was all centralized in Washington, D.C. And this is a problem, because prior to that, the data was actually quite accurate. And then all of a sudden, it got worse, and it continues to get worse. So I want you to see here, again, bad data leads to bad policy. And again, the write-down of jobs is likely to be substantial. But let's talk about the trend here, because that's what really matters. Let's go back to what happens post-pandemic. We see a massive number of jobs created, around 462,000, and that was the revision then. What follows is exactly what we said would happen, is the U.S. economy and the global economy were starting to slow down, and the evidence was in the labor market. Now, there was a problem here. The non-farm payroll report didn't actually report that. Instead, we saw a lot of other statistics tell us the labor market was weakening, and then the revisions hit. Look what happened in 2023. We see a write-down of 306,000 jobs, followed the following year by over 818,000. Now, somewhere experts are saying could be 800,000, could be 1 million jobs removed from payrolls. And again, this has massive implications, because what it indicates right now, if the Fed had the actual data needed, it said they're massively behind the curve. That's in addition to the revisions it conducts in each month's jobs report, all of which ultimately makes the data more accurate. And that's really the key point here, is the BLS no longer has accurate data, because ever since they centralized everything in Washington, D.C., the initial response rate has plummeted. And this is a major problem, because President Trump says we need accurate data. Well, the reality is we need to go back to regional Bureau of Labor Statistics data gathering. That is the one thing that could change and make the report far more accurate. But something that's getting more accurate, and that's happening now today, this is our Metre strategy. Check out this trade on GDXJ. We told our subscribers to buy on the open on the 5th. We gave them risk control levels. That trade up as a close of business Friday, 3.64%, and going higher even today. But we have made a game-changing move here when it comes to trading is we have optimized every signal in our report based on its own individual security. Now, nobody else does that. They said, look, we have one signal that works with everything, but it doesn't, and I can prove it. And as of today, our Metre strategy is fully optimized, fully AI powered. All you got to do is grab those links in the description below. Use the coupon code for your free 30-day trial. Stay tuned to the end of the show for more information. He says, all things being equal, downward revisions to job growth does increase pressure on the Fed to ease policy. And again, this is the major point here with the Fed. You talk about bad data and you get bad policy. The problem now is the Fed's going to find out there were far fewer jobs created than they were told by the Bureau of Labor Statistics. So again, it is setting up the Fed to cut rates here, because when you understand what the Fed does, they focus on inflation until the labor market gives up. Now, the question was, is there signs that this was already happening? Well, the answer is absolutely yes. And of course, we've been talking about on this show. Let's take a look at the non-farm payroll report in blue, showing in change of thousands in persons against the federal fund rate. And I want you to see that the Fed reacts to the non-farm payroll report. They don't anticipate it. This is very clear. We can go all the way back into the 70s and 80s, and we can see the Fed really doesn't cut until you start to see some negative payroll reports here. And that's the issue. We might likely have seen negative payrolls over the last 4 months, but due to the inaccuracy of the report, well, we get bad policy. And there again, it's all a major problem, and it's not going to change soon. And though the revisions wouldn't change the current understanding of the labor market, they would suggest that the step down in hiring seen in the recent months actually began much earlier. But we already knew this. There were so many signs. Again, we'll take a look at some of those, but it's baffling to me that people didn't see this because they were so fixated on the non-farm payroll report. Meanwhile, what was I saying? Look at all this other data. And then the non-farm payroll would come out and people would say, Steve, you're wrong. See what the payroll report said? But it turns out the payroll report was wrong the entire time. But again, there were signs all over the place. Let's take a look here. We've got the non-farm payroll report again, still in blue, now against the JOLT survey. That's the job openings and labor turnover in red. And what do you see? This is Janet Yellen's favorite survey in the JOLTs. Why? Because it tells you where the non-farm payroll report is likely to go. And again, that's a key point we've talked about, because businesses, when they don't want to hire, the first thing they do is they cut job openings. It's a leading indicator. But there was another one. And again, this is so obvious because we've talked about how weekly hours have stagnated for over a year. But look at the relationship between the non-farm payroll report. It's extremely obvious that there was issues with this report. But yet investors and businesses, they get caught up on the headline, and you can clearly see as the red line declines, it takes payrolls right along with it. And again, that is the issue at hand here. And one of the questions I said at the beginning of the show I wanted to ask you is, does monetary policy fix this? Well, hang tight. We'll get to that in a second. Revisions have been bigger in recent years, and this is the most important point right here, partly due to declining response rates. So I want to take you back to when the BLS had regional people working for it. Their job was to get the responses, to make sure the data was accurate or as close to being accurate the first time out. But after it got centralized due to budget cuts, what happened? Well, all of a sudden, the response rates have plummeted. So the reason we get these big revisions, the second month and the third month, is because more data comes in. And so, of course, they have to adjust for it. So in the beginning, they're largely kind of guessing how this is going to be. And now you talk again. Bad data leads to bad policy here. Now, the question is, does monetary policy fix this? Well, the answer is no, because it really doesn't change the labor market. Think about this from an employer standpoint. If you've ever been in the role of hiring, have you ever thought, well, if the Fed would just cut a quarter basis points, I'm going to hire somebody? You never think that. And in workers, they don't ever think that, hey, if the Fed would just cut, that means there's going to be a whole lot more jobs. Now, how about from the consumer perspective? Well, in a lot of cases, they don't necessarily spend more just because the Fed cuts. But there are cases maybe on big purchases like homes or cars that a rate cut would get somebody to buy something. But overall, the issue here is when we look at the real economy, you look at what went wrong, it was all based on bad data. And this bad data got everybody excited that there was going to be a turnaround in the economy in the second half of 2025. We've been hearing this since 2024. And yet what happened? It didn't turn around. But what did businesses do? They built up massive inventories, and now they're looking for someone else to blame. The problem is we've been seeing signs of consumer stress for years now. Let's turn to McDonald's because they're giving its new value meal another shakeup on Monday. I remember back when I said the first time they came out with their $5 meal deal and they said it was temporary, I said not a chance. Once again, they're saying this is temporary, and I'm saying not a chance again. The new menu is expected to last until the end of the year. The revised extra value meals are just the latest in McDonald's recent attempts to repair perception that has gotten too expensive. But I don't know about you, but in my book, an $8 Big Mac meal, that's too expensive. Same thing with their breakfast thing. It's $5 for a sausage and egg McMuffin or maybe a regular muffin. I don't even know. But I still think that's way too expensive. But look at what McDonald's is saying. It's all about perception. No, McDonald's is not about perception. It's about the fact that wages aren't keeping pace, that the economy isn't working for a lot of Americans. And when they see an $8 value meal, they don't think it's a value at all. Because look at the real issue facing American households right now. You look at inflation in blue, but let's talk about total income. And this is when you combine weekly hours against average hourly earnings of production and non-supervisory employees. You can really see what happened here. You go back to 2021, what happens? Inflation's taking off, but wage growth is slowing. So American families fall further and further behind. Now the argument is this, look, wage growth and incomes are higher than inflation. The problem is it's not enough. People are already too far behind. That's why we're seeing the delinquency rates rise. And so McDonald's answer is simple. We just need to put up some extra value meals till the end of the year. But the reality is, and they don't get it, this problem isn't going to get fixed by the end of the year. And a rate cut won't do anything because nobody bases their decision to go to McDonald's based on what the Fed does. In the same earnings call, CEO Chris Kazemski said the consumer's value perceptions are most influenced by a core pricing menu. And visits from low-income consumers once again declined by double digits versus the prior year period. And he notes that purchases from middle-income consumers have recently improved. Well, that's because the economy got a little bit better. We saw hours worked ticked up a little bit. And yes, we saw companies competing for consumers by lowering their prices. And Chris, this is what you have to get. There is less demand for fast food, or there's less demand for everything, which means you have to compete on price. It's not about the number on your board. It's about the fact that the average consumer looks in their wallet and then they decide if they can afford your price. The problem is people can't afford your price. Now, I talked about how this could set up for a massive correction in the market. Let's take a deeper look at this. Because stocks are at risk of sell the news drop on Fed interest rate cut. This according to JP Morgan. And this is the major risk here. Because what do stock investors, what are they trained to believe? Rate cuts are bullish for stocks. But yet, why is it when the Fed aggressively cuts rates, the stock market goes down? Again, you talk about, is monetary policy going to fix this? Well, it doesn't fix the stock market. The problem is, according to JP Morgan, is more tariff-induced cost pass-through on the horizon, the speed and magnitude of which are unknown. Additionally, rate cuts could spur labor demand and in turn trigger wage inflation, which is typically sticky. And again, that makes absolutely no sense to me. You know, the notion that all of a sudden you cut rates and there's going to be a big surge in labor demand, there's no evidence of that. Because if you want to get an increase in labor demand, you have to have a reason for people to work. And what are we hearing from the ISM right now? The new order growth in the manufacturing sector continues to contract. On the services side, well, it's fairly weak. But what about backlogs? On both sides, they're getting depleted at rapid record pace. There is no demand for workers. So the issue here with the market is, if inflation is low and the Fed is cutting, that is very bullish. But if you're facing a rate cut due to a weakening labor market, that's not bullish, because if consumers are losing their job, it means they're not spending. Not spending, well, you don't see profits and you don't see stock prices going up. But Double Line's got this on the money. They say the Fed rate cuts will lead to a steeper yield curve, and that is a spot-on assessment to what's going to happen here. Now, what is the yield curve? Well, it's the gap between 2-year and 10-year yields, and what Double Line says is that is growing right now. And the reason it's growing is very simple. The bond market's telling the Fed very clearly, you're going to cut rates in your meeting of September. And the problem is, after you cut rates, well, you're going to be cutting them again in future meetings. Let's take a look at the yield curve shown in blue, and I've got it inverted, so I want you to see the relationship here with the federal funds rate in red. Very clear, very obvious. As you see the yield curve steepen, again shown inverted, the Fed's going to cut rates, and that's exactly what the bond market's telling us right now. And it's also a wake-up call for investors to think that stocks can only go up because, again, take a look at the NASDAQ 100 now shown in red against the inverted yield curve. What do you see? As the yield curve goes down, particularly as you're headed into a recession, it's very bearish for stocks. And that is the risk. We could be facing the peak of the market here. Remember, I said, when the Fed starts to cut rates, you have upwards of 3 months before the stock market wakes up to reality. Well, this QCW revision is going to be a massive shock, not just to consumers who are going to be extremely frustrated by the labor market, not just to the president who's going to be angry about it, not just to policymakers who are going to be shocked, but what we're going to see is everybody across the world is going to start to panic because the realization, once U.S. consumers are tapped out, well, there goes the entire global economy. And the evidence is clear. Let's turn to New York as the outlook for job seekers seen as a record low. This according to a recent New York Fed survey. And for those who lose a job now, the prospects of finding new employment within 3 months dropped by almost 6 percentage points in August to the lowest reading since the New York Fed began asking the question back in 2013. It's also the sharpest downturn in 1 month since the pandemic. So what we're going to see from the non-farm payroll report is, again, everything we've been talking on the show for years. We've been saying, look at all these other data points. They're very clear that the labor market here is weakening. It's very clear that the U.S. economy is headed into recession right alongside the rest of the world. And what we're hearing from workers is, look, if I lose my job, the odds of me getting another one are getting very, very bleak because everything is coming down to finances. You want to turn the economy around? You need to create jobs. How do you create jobs? You need to burn through all of these inventory overhangs. And based on what we're hearing from consumers right now, that ain't happening. Consumers' views of the prospects for their financial situations also worsened. The share of consumers saying their financial situations were worse than a year ago rose, as did the share of those expecting a worsening in the future. Expectations for future access to credit deteriorated, while perceived chances of missing a minimum debt payment in the next 3 months rose. So again, you go back to the CEO of McDonald's and he's like, hey, we just need to get the right numbers on our board. No, it's not going to work because what you're seeing is the labor market and finances are deteriorating at a faster rate. That's why none of this is going to work. That's why the Fed's going to cut. And they started the show out. Will a rate cut fix this? The answer is clearly it's not. But some way you can make money in this market no matter what happens is through our new Metre strategy. Again, it's now fully optimized, AI powered. This is going to change the game and the way people trade. Now, what is our Metre strategy? It's an advanced trading system that combines 9 professional trading strategies into a single intelligent signal generator. It provides 31 more frequent buy signals than individual strategies while maintaining high quality through multi-strategy consensus. But what we just did, if we individually optimize every strategy for every security, this is something nobody else has done. It has a target hold period of 2 to 15 days. It generates over 155 signals per year and has a success rate of 55% with fast profit taking, and that was before we optimized it. Now, I haven't back tested it to see what the new number is going to be, but I can tell you based on the individual back test, it's going to blow away anything out there. Fully optimized for swing trade. Now, how do you get this? Well, you got to sign up for either one of my reports. Now, if you want to trade against machines as CTA Timer Pro, want to trade momentum signals, that is our Momentum Timer Pro. But either way, you get those reports and you get the tradable signals from them along with the Metre strategy trades. You also get my opinions on the best trades, risk control levels, a full tracking of all open trades and returns, a weekly update, and here's the best part, you get a free 30-day trial. All you have to do is grab those links in the description below, use the coupon codes to get your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.